Okay, folks, welcome to the Week Ahead Commentary. Hope everybody's having a great weekend, and let's get ready for the week ahead. Okay, last week we had economic data that was released that was not bullish whatsoever, and it was reflected in the stock market. You had Empire Manufacturing Index, which came out, or the market expected 18. It came at 11.9. Housing starts. The market expected 563,000 new units to be built. The prior was 585,000, so they already brought it down. It came in at 523,000 units. Building permits. You know I love leading indicators. And building permits, prior month, 574,000 new building permits. The market had expected 590,000. It came in below, a huge miss on building permits. So the market expected an increase over prior, but the actual came in below the prior. That's not good. Industrial production, prior month, 0.7%, market expected 0.5%. We came in flat. Um, I know that wasn't it. FOMC minutes, a little bit more bullishness, hawkishness, I should say, on interest rates. Initial jobless claims, prior month was 438,000 new jobless claims. Market expected 420,000. Actual was 409,000. Now, it's good for the economy. It's good for the country for initial jobless claims to fall. We need as jobless claims begin to fall and jobs begin to pick up, uh, you have to take a look at earnings, and that's going to be coming out next week, and we'll discuss that in a little bit further detail then. Leading indicators. This is a really bearish number here. You had a prior number of 0.7%, almost a full percentage point on leading economic indicators. The market expected a flat number. We came in negative 0.3. Very, very big miss. Okay, next week, this coming week, I should say. Um, I mentioned uh, the personal income. You want to start watching this number here because the Federal Reserve has been able to stay on hold due to the fact that the average American worker hasn't seen their salaries rise relative to inflation. So once you begin to see this rise, that's inflation at the producer level. And although it's good for Main Street, it's not good for the producers because it's going to impact their bottom lines. And it's also a signal to the Federal Reserve that we need to begin to raise interest rates because that's truly inflationary. Both the dry C index, uh, this has run counter to the markets of late, but I believe that um, what we are seeing here is the beginning of a double bottom. We had a low here back in January, rally in February up to the 1585 level, pullback. Looks like we're going to put in a higher low, which is bullish on a weekly basis for the Baltic Dry Sea Index. Now, could that mean the fact that some is a global growth, or as Jim Cramer says, who discounts this indicator completely, that the the which I completely disagree with, is discounting this. I watch this religiously. That the shippers have the ability to, as much as the airlines did, mothball some boats or ships and then be able to raise rates. Now, if they're doing that, you only want to watch the individual shippers and see how they're performing. Because if they're mothballing ships to raise prices of shipping goods, then that's not bullish for global growth. So you want to look to the shippers to rally because they're able to charge more, and that will help their earnings, much as what occurred with the airlines. Now, if it's a global growth story, that's good for everybody. And you want to watch not just the shippers, but the stock market in general. Let's get to the Dow Jones Industrial Average. This is a daily chart of the Dow Jones. Actually, this is a weekly chart. I'm sorry. We found support at the 12,500 level. This is critical support here now, folks. What we might see is an attempted rally, trying to break out higher above the 12,876 level. But remember, the test is always at the top. If we fail here, you can expect that the 12,500 level will not hold next time around. So if you see that rally and we roll over, you're going to see lots of selling. It's going to be a big sell signal. 12,005 is not going to hold. Dow Transports had a attempted rally last week, tried to break above that previous support, the lower band of the rising uptrend line, which is now resistance. So we saw that resistance with a little bit of a topping tail on Thursday. Friday, follow-through action to the downside, very bearish. You have a little bit of a bottoming tail on Friday. Let's see whether or not the Dow Transport's going to be able to consolidate sideways and perhaps break out higher. It can happen. It's happened before, much as it did back here. So we'll see. We'll watch and we'll wait. U.S. dollar. Okay, U.S. dollar, you'll remember, this is a daily chart, back here, I was mentioning that these bottoming tails here were very bullish for the dollar. And a reversal, a trend reversal was imminent, and it couldn't be ignored. And here we are. Look at this rally, a beautiful rally here. Nice pullback, but we have resistance here at the 75.50 level. Let's see whether or not we're going to get a continuation rally up to 76. If we do and we break out, that's going to be very, very bearish for the overall stock market. S&P 500 on a weekly basis. This is a bullish chart to me. If the trend is your friend, which it is, you have a pullback here on light volume for the most part. See, the volume hasn't been strong down onto the downside at all. So you have a light pullback against the rising uptrend line, and you have a doji formation on the S&P 500 last week on the candlesticks. Now that tells you that there's indecision between bulls and bears of where to take this market. Now what I don't like is I don't like that this what appears to be a head and shoulders formation forming on the RSI. The MACD is attempting to hold in there, but as you'll see later with the IWM, when I bring that chart up, that chart is not holding up. The MACD is not as strong in the IWM. Now, perhaps you're going to see money flow into the big S&P 500 companies due to the fact that they have dividend support. The IWM, the Russell 2000, does not have that. So we'll probably see less of a sell-off in the S&P 500 stocks rather than what we're going to see on the IWM, which is why we remain short of the IWM. So remember, going into the week, we had a neutral week last week. Although down, it was only down slightly. Volume dropped, and we are against the lower band of the rising uptrend line. We do have an accommodative Fed, so don't be surprised to see them try to take this market higher. IWM, which I just mentioned, same type of chart action on the candlestick action as well on the IWM, Russell 2000. However, you could see that the stochastic under the oscillators, the RSI, are weaker than on the S&P 500. Volume rose last week above the average weekly volume. The MACD, remember how on the S&P 500, let's go back, take a look, was fairly tight, although beginning to gravitate away from the red slower line. On the IWM, you're already seeing quite a bit of distance between the black line being the faster line versus the red line being the slower line. So that's not good. So we'll remain short of the IWM for now anyway. The VIX. The VIX is telling us here, this is a daily chart of the VIX. Although you had some bearish days last week on the VIX, some sell-off and volatility, Friday was just a massive, massive bullish day. And I would expect to see more strength in the VIX, which of course means weakness on the overall market. So keep an eye on the VIX. People are buying volatility as protection against their long positions. Complacency is leaving the market, in short. Okay, the 10-year yield, as reflected here for those new members, we always watch the 10-year yield versus the S&P 500 overlay here in black. And you can see that we had a divergence here. S&P 500 was continuing higher. The 10-year yield was lower. Now, these two usually trade in tandem. You can see here. Now, I mentioned several weeks ago, watch out, you have a divergence here. One of them is right. It's probably going to be the stock market that's going to correct. Sure enough, here's our correction. But there are reasons to be somewhat bullish on the 10-year yield, and that means you're bullish on the S&P 500. You have the Stokes moving up stronger, they're hooking up. MACD appears to want to hook up higher. Williams percentage R showing a little bit of weakness here, but if it can hold this 80 level here, I'd expect to see a breakout higher on the yield, which should mean strength in the US dollar, assuming that the yield does not have a parabolic move. If you see the yield on the 10-year bond break out into the 4 or mid-4s, 4.5%, that's not going to be bullish for the stock market. So you want to see the 10-year yield trade within a range here. And that'll be bullish if we can get a rally out of the 10-year yield. Let's proceed further. Goldman Sachs, of which we are long. It's extreme oversold levels. Now, if you are not long of Goldman Sachs, we got long of it due to the fact that we had some bottoming tails here. And it was nearing extreme oversold levels. It is now at extreme oversold levels, and we're going to remain long of Goldman Sachs. We're in a very small position. And you saw volume rise. This stock was just so weak on Friday. I was so tempted to buy more, but I didn't. And the reason is even though, this is what I ignored. This is on a 10-minute chart. Look at how oversold you are on an intraday basis, 1272. I ignored it. And you're probably going to see a slight rally on Monday. So if you do open up weekend, or if you want to day trade this, if you're a day trader, I'm not one that does that. You'll probably see a rally here to relieve this oversold condition, but I'm fairly convinced that on a more of a swing trade basis, when you want to get long of this stock, I'm convinced that you're going to see 128.62, which is where the previous support was. So I want to see 128.62, get long more of Goldman Sachs. I'll probably double up, if not thrice more of that position. I always wanted to use that word, thrice. Anyway, S&P 5, semiconductor holders. Attempted rally here. Remember, the test is always at the top. It rallied, broke above previous highs, only ever so slightly, was not able to hold it. We're trying to hold 35.90 level. As the IWM is an indicator, I'm sorry, scratch that. Let's backtrack. As the financials are an indicator of the performance of the S&P 500, so are the semiconductors a measure of performance of how you can see the NASDAQ composite move. So if you see the semiconductors continue to break down here, expect the NASDAQ to follow. Okay. Let's get the West Texas Intermediate crude. We're seeing some nice bottoming action here. Remember, they're not producing any more oil, folks, and Obama has seen to that. We are not going to do it here in the United States. That's darn prudent. So, you have militants taking over in Egypt. You have the rebuke of our only ally in that area, Israel, by our President of the United States. And that same president, or prime minister, I should say, Benjamin Netanyahu, who just took his thumb and shoved it correctly right in Barack Obama's eye on Friday. The tensions in the Middle East are going nowhere but fast. They're not going away, folks. We have a president that is pro-Muslim. It shows a sign of weakness. And to our Muslim brothers out there who are members, this is not I'm talking about militant Islamists, not you folks. He is showing weakness. And for everyone in that region, you'll know that the only thing that militant Islamists respect is strength. And our president is not reflecting strength whatsoever. He's reflecting weakness. He's like the Neville Chamberlain of the 2000s. And we all know how Chamberlain did as Prime Minister of Britain. And it took Churchill to fix that problem, and the United States. So I remain bullish on oil. And one of our trades on both potential bullishness on shipping and on oil is Gulf Mark Offshore. Nice pennant formation here. You remember this is one of our shorts. We added to the short watch list several weeks ago. It's corrected. It looks like it has a great, great foundation here. This is a very, very good company. You can begin adding to this on consolidation. I like it. A little bit of, I drew this trend line here on the Stoke RSI. A breakout above this as you signal to get long. Ultimate oscillator, look, nice double W formation at the 50 level, which is the neutral zone. Great action. I like it. Your Stokes are moving up higher. MACD, nice double bottom on the MACD. I like it. So let's look to add the Gulf offshore soon. I was swapping emails on Saturday with fellow member Kevin, and I had a more negative tone on the performance of silver in my emails with him because we were just going off of the ZSL chart and a daily chart of the SLV being the silver ETF. I said I might mention it on the week ahead commentary, and given the fact that I've become a little bit less bullish on the ZSL, I want to definitely put that out there so Kevin and fellow members understand my position on this right now. Because what I didn't look at when I was swapping emails with Kevin was that although the ZSL is in a pennant formation here and looks somewhat bullish, on a weekly chart, silver had found support. It recaptured previous support at the, say, 3250 level, closed where? 3418. So we might see an attempted rally going into the week. That assumes that the US dollar is not rallying as well. Now, as far as the ZSL trade is, I wouldn't touch silver until it gets down to $28 per share. So I'm still bearish on silver, which means I'm bullish on the ZSL. So if you're going to trade this short ETF, my suggestion is this. If you're going to add it, put a static stop loss order, not a trailing stop loss, but a static stop loss order right below the, use an odd number, $19.13 per share, $19.13. Put your stop there and just get out, keep a small loss just in case silver rallies. And obviously 1921 was the previous low. So that's the way I would trade ZSL right now. Or I would just honestly sit on the sidelines as the best bet and see what happens with the US dollar. And Kevin, if you have any questions on that, please shoot me an email. We'll discuss it even further, okay, pal? I just wanted to bring that to your attention and fellow members as well. TZA, which puts you short of the IWM. A little bit of a topping action here on Friday. So we might see a little bit of a pullback. The trend is still intact on a short-term basis. I wouldn't be a bit surprised to see a breakout higher, honestly, on the TZA. I'm more bullish on FAZ, which puts you short of the banks. Beautiful action on Friday. As soon as it takes out this 43.85 level, if you like the momentum trade, that's where you jump in. Okay, it's in an uptrend here. Since the 37.05 level, it's in an uptrend, and it's looking to break out of this base. This is your base here, and once it does, it's off to the races. So we're going to remain long of and possibly add to the FAZ. UNG, natural gas. I firmly believe that natural gas is the next oil in this country. We can't afford not to. So here you have, yes, did it break trend here? Yes, it did. However, you're seeing a great W formation set up. Here's your left side of that W, middle side, right side. Great action on Friday. I wouldn't be a bit surprised to see it rally higher. You're also seeing on the macro basis, bigger picture basis, you're seeing the 50-day moving average hooking up. And you're going to want to be long of UNG when this converges, meaning the 50-day moving average crosses above the 200-day moving average. You're going to want to be long because you're going to see a lot of technicians get involved to the long side on UNG. Nice action here. Nice double bottom on the UNG RSI. So I'm staying long of UNG, if not adding more. Rambus. We had Rambus put to us last week, meaning for those members that are new, we sold a put option. And we collected about 85 cents per share. So we sold the $19 strike on Rambus. It's a very, very volatile stock. So for those who are faint of heart, this is not the stock for you. All right, please stay away. Those who do like volatility, like I do, not this type of volatility. This is absolute insanity. I try to sell here, close out that position here with a big profit, but the circuit breakers kicked in, and I counted 3. At the end, I found it was 6 times the circuit breakers were triggered this trading day. Amazing. So we had it put to us. What we're going to do is we're going to look to, given the fact it's so far extended from its 50-day moving average, we're going to look for further strength on Rambus. I'm going to look to sell covered calls to hedge this position. You have a $4.3 billion antitrust case that Rambus is there the plaintiff in. And it only guarantees one thing. It doesn't guarantee they're going to win, doesn't guarantee they're going to lose. This guarantees that the stock is going to remain volatile. So we're going to look to sell covered calls, hopefully bring in minimum 80 cents to $1 on them. I'm not sure of the strike date yet. I will get back to you on that. Let's move forward. Intel. The reason why I'm bringing up the Intel chart is oddly enough due to the fact you had the LinkedIn trade that came out last week, the IPO of LinkedIn. Now, this just goes to show you the absolute corruption that goes on Wall Street. Here you have Goldman Sachs, who came out on Thursday, the 19th, oddly enough, the same day that LinkedIn went public. Goldman cuts Intel to sell. Now, LinkedIn, who is the sole underwriter of LinkedIn? Goldman Sachs. They're selling 871,840 shares of LinkedIn shares. Go figure, folks. So, I wanted to get long of LinkedIn, but realizing that Goldman created artificial liquidity to help support this stock, I do believe that LinkedIn is going to come back down and it's going to retest its IPO lows of 80. I was going to press the trigger at 85. It would have been good for a trade, but you know what? No, it wasn't good enough for me yet. I want to see it hit lower prices. So, given the market potential weakness and the fact that Goldman created a liquidity market for LinkedIn, I went back and take a look at the Goldman Sachs IPO. Because remember, LinkedIn is a social networking site, and it's a precursor for Facebook. Now, what you're looking at is a weekly chart of Google. It only goes up to 2006. This is not present day here, okay? Don't go buying Google on Monday morning based on the fact it's got consolidation of its 50-week moving average. Yeah, back in 2006, you would have been right. This is not current day, all right? This is the IPO back here. IPO came out in August of 2004, rallied for that first week, attempted rally the second week, pulled back down, almost retested the lows of the IPO price. I'm expecting the same on LinkedIn. So look for LinkedIn to come in. This is a 60-minute chart you're looking at. Come in and retest at $80 per share level. Then we're going to begin to buy LinkedIn. I like LinkedIn. It's got a better business model, believe it or not, than does Facebook. It has revenues. It's also profitable. So we're going to look to add LinkedIn as an investment. I like this sector. You're already hearing people scream about year 2K. Is the market getting ahead of itself? You know what? When people start talking like that, that means the early stages of the market. I believe the social networking site is going to head higher. Let's get in at a cheap price. And that's pretty much it, folks. Hope everybody has a great trading week. If you have any questions, shoot me an email, and I will talk to you soon. Have a great trading week, and enjoy the rest of your Sunday. Bye-bye.